Hello, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. It is Monday, November 22nd. My name is Will Gibson, and joining me this week is Joseph Tizzolo. And it is the last podcast before Thanksgiving. If you're watching this on YouTube, Joseph, you could see I put on a special shirt for this. This is my holiday button down. So expect me to be wearing this in the office when you see me next. But something else as we're approaching Thanksgiving, as I seemingly change my button-down wardrobe, is that volatility is usually often quiet during this week. You see a typical roughly 30% reduction in trading volume over Thanksgiving, a very similar theme over Christmas. And some other notable holidays we put in our report earlier where you see lighter trading volume. But something that is affecting markets today that we're going to start talking about is the recent appointment or reappointment of the Federal Board or Federal Reserve Chairman Jerome Powell. To be specific, looks like he will be reinstated for another term. And that seems to be affecting the market in a pretty notable way today, which we're going to unpack a little bit later. We're seeing some notable movements from rates, sectors, as well as a size and style perspective. And broad picture here, that seems to be the story, is that Powell is slightly more hawkish than the alternative, and markets seem to be pricing that in. But Joseph, specifically, maybe if you want to touch a bit about more specifically what we're seeing on the rate front.
Yeah, and since the appointment this morning, since the announcement came out, we've seen rates reverse up on that trend chart. 10-year yields are now back above 1.6% after pulling back last week. So we've seen rates reverse up, and we've seen a notable effect on the sector performance there. Energy is leading the way, followed by financials. You also see consumer staples, as well as industrials and materials moving higher. So we start to see that value trend with rates moving up starting to solidify itself a bit there. And we did see tech, perform pretty well at the open. But has really faded throughout the day as rates have moved up higher. So aside from a few of those mega cap growth names like Apple and Tesla today, we've seen some of those large cap growth names cool off where values kind of come into the equation. And you might have a little bit more to touch on that, growth versus value relationship and what we've historically seen on that front.
Yeah, I will certainly. And rates, you mentioned there's been a lot of volatility there lately. Today, more of the same for that matter. And I was just looking at our 10-year treasury chart, and the year-to-date performance caught my eye. It's up over 70% year-to-date. That's typically not something you would see, but a dose of perspective. I mean, a year ago, we were well under 1%. So some marginal moves higher, and here we are 70% up year to date. But a lot of volatility in rates. Like you mentioned, we've already seen some intraday sector movements reversing course. Tech was a notable one that I saw as well there, Joseph. And then on the size and style front, like you said, out of that sector deviation, we have seen some notable spreads develop between the growth and value camp. 2021 has been pretty notorious for that growth value battle. It seems like the barbelled approach has been correct to ride out a lot of this more often than not. You've seen some pretty severe periods that were in favor of growth or in favor of value. The most recent one was strongly in favor of growth. We put this in our report last week. It was looking at the rolling 6-month spread between proxy ETF RPG, which is your S&P 500 value, or excuse me, S&P 500 growth, and then relative to RPV, which is that S&P 500 value fund. And that was at multi-year highs in favor of growth. So that trailing 6-month performance was notably skewed in favor of growth. Today, without performance from value, you are getting a slight move more towards mean or more towards normalized levels, I would say, at least, but still looks like there is heightened potential for some near-term mean reversion based off that spread in favor of value. That would be another way to look at this is by OEF, so the S&P 100 representative of the biggest names, and then RSP, which is your S&P equal weighted. Very similar framework also in our report. Joseph actually put this piece in there. So if you haven't read it, I'll suggest taking a look at this, but similar OEF relative to RSP, also strongly in favor of OEF, at least leading into today, telling us that those mega cap names have really been driving the performance lately, or significantly outperforming a broader equal weighted basket of the S&P 500 represented by RSP. And something on that chart I think is interesting to note is that if you go all the way back to 2000, that chart typically spends more time, or has spent more time, below 0%, which tells us that RSP has historically been a bit more resilient and a bit tougher to compete with. But since 2016, you've really seen that spread, that rolling 6-month performance spread, stay above that 0% line, which tells us that your mega cap names, the S&P 100, have been tougher. You see a huge spike, the highest level on the chart, really coinciding around February, March 2020 time, where your mega cap growth ended up being your flight to safety in the equity markets. You saw a huge performance spread in favor of OEF, your S&P 100, and that sharply corrected. If you're following us on YouTube, we'll put this chart up there, but that sharply corrected in favor of RSP later in 2021 when that breadth widened out. And then now again, we see that still strongly in favor of those mega cap names, even with today's action. So the reason we bring that up is because you did see some technical developments heading into this decision that said that, you know what, maybe we were a bit extended on the growth spectrum. Still plenty of space there. There's still a lot of strong pockets of relative strength on both sides of the coin, for that matter. So some opportunities there, but macro picture looks like you're getting a bit of style reversion. One more note on that I want to mention as well. We talked about some intraday deviations. Some people could call that kind of movement volatility. Something else that I was looking at, Joseph, we were talking about this earlier today as well. The VIX, so the S&P volatility index, which is signifying implied volatility or implied market moves, typically inversely correlated to the market. So VIX is rising, your fear index per se is also rising, for that matter. Expectations for equity returns for forward priced in markets typically move inverse of that. But similar picture here again today, a change of direction. You saw the chart actually print 3 O's intraday, falling lower, but now it looks like VIX is going to be up about 1% on the day, reversing that course. But even with that reversal, or that movement higher today, the VIX is still below historical levels. Right now, we're sitting at about 18 in terms of implied volatility. And historically, this has been around like 23 around this time of the year. And this is another chart that we'll put up on the YouTube page. But 2021 has been a bit of an anomaly in that sense as well. You've seen some extreme deviations, but volatility lately has been pretty quiet.
Yeah, and to add on to the volatility portion, we look at the VIX, and that's based off S&P 500 index options. We've also seen the MOVE index, which the ticker is ML MOVE on our site, and that looks at the option pricing relative to the 3, 5, 10, and 20-year Treasury indexes. So we've actually seen that MOVE index at fairly elevated levels recently. So we've seen rate volatility tick up substantially over the past, month and a half or so, even more so today with the Jerome Powell decision, and that's how that's been affecting rates. So, we do see a low equity type of volatility, at least priced in right now, but we see a very high volatility priced into the Treasury market. Typically, we do see those have some sort of correlation. Like Will said, you mentioned that the VIX is typically higher this time of year. And we also have a pretty wide spread between the Treasury volatility versus the equity volatility. So we could see some volatility within the equity space from a long-term perspective reversion, as well as its relationship with fixed income volatility as well.
Yeah, I think that's a good point. In general theme there is that we wouldn't be surprised to see a continued uptick in volatility, maybe that point of mean reversion heading into year end there, both equities and fixed income for that matter. Even some of those spreads that we talked about before, the fact that those needing to normalize, you could also see some volatility arise from that heading into year end. You're also going to get some portfolio rebalances. All of that could contribute to some minor upticks for that matter. But at the end of the day, looking at the S&P 500, it's still up well over 20% this year. It looks like it's going to be up another about 50 basis points on the day right now. By and large, like Joseph mentioned, we are still seeing some strength from a handful of those mega cap stocks. It looks like that's holding the index together well today, as well as some of those underlying participation, some of those smaller size names. They're also picking up participation, which is a healthy sign. We would like to see breadth continue to widen here, given that we did see a notable contraction for the past couple of weeks. S&P 500, if you're looking at the chart on our system, default chart broke a triple top today, intraday all-time high, fair amount of demand for your broad domestic benchmark, and heading into year end, really following its seasonal pattern, a pretty strong close to the year. So trend of least resistance does seem to be higher for your broad benchmarks here on the equity side, at least. And then a fun statistic, and I think this has been circulated pretty well at this point, but as we close out here, when your S&P 500 for the calendar year has been up over 20%, that's historically signaled strong returns heading into the next year. If you're looking at average returns, it was positive in the next calendar year 84% of the time. If you're looking at median returns, they are positive 72% of the time. So we typically do see some type of follow through heading into next year. Nothing is certain and nothing is guaranteed, but trying to get as much technical evidence as possible heading into the year end, I think is going to be notable here.
Yeah, and it's really, like we touched on, the S&P broke a triple top on its default chart. So we can speculate about volatility and all that kind of stuff all we want, but really until we start to see prices, reflect anything to the downside, there's no reason to fight it right now. And we are in a seasonally strong period where we typically do see, the Santa Claus rally or whatever you want to call it, where equity prices tend to trend higher. But it's it's good to keep the volatility stuff in mind. As well as what we're seeing with rates right now. But until that gets reflected on the price charts, there's really no reason to, get worried about anything just yet.
Yeah, for sure. And point and figure being unique in that you need those 3-box reversals. You need to hit certain thresholds on those charts. So it's going to inherently thin out some of that market noise for us to really plot meaningful action like we're seeing recently. So I thank you all for listening. That's really all we had on the docket to bring to you today. We hope you have a great Thanksgiving, and we hope that if you have any questions, you'll reach out to us by phone or email. We thank you for your time, and we'll talk to you next week.
Happy holidays, everyone.